So today's topic is LMI, or Lender's Mortgage Insurance, and I'm joined again today by Tammy the intern. Hi Tammy, how are you today?
Hi, I'm well, thanks, and I'm not actually an intern because it's been more than 3 months.
It's been more than 3 months. You're an employee now, aren't you?
Yes, I have been, but I guess intern is the nickname.
It's hard to shake something like that, isn't it?
Yeah.
Hard to shake that, or it is when you've got an idiot for a boss.
No, why would you say that? You're not.
Yeah, you know I am. What have you been up to this week?
I've been studying, doing assessments, procrastinating, looking at properties on realestate.com. I've done lots of things.
Whereabouts have you been looking lately?
It's always the same places. I look at Palm Beach, Mona Vale, Manly, Drummoyne, Narrabeen, just places by the water and these beautiful homes that I know is not within my reach.
Yet.
Yeah.
Yet,
I guess.
Yeah, sometimes it takes a long time to get where you want to go. Yeah, interesting. Okay. Yes, but you've been hopefully you did a day's work as well, didn't you, on Wednesday?
Yes, yeah.
Yeah, nice. When are you on study break?
Oh, my StuVac.
When is Stuart Vac going to be hanging around at your place?
Is in like 3 weeks.
Oh, okay, so not long to go. Okay, so today's topic, what's the question today? So I can understand what you're asking.
Yeah, well, LMI, or Lender's Mortgage Insurance, is something that I always come across when I'm like researching things, even helping like client applications. But all I really know is that above 80% you have to pay LMI, below 80% you don't have to. But I don't really know like what it entails, or if I go somewhere else, what's the best option? How do I lower my LMI costs? I don't really know any of that.
Cool. Okay, so let's start out with the 80% figure. So lenders in Australia, if they lend above 80%, typically have to get lender's mortgage insurance, so that in the event that you don't pay the mortgage, they don't lose lots of money.
Yeah.
But actually, for some professions, they'll let you go higher than 80% without paying lender's mortgage insurance. Firstly, people in the medical profession, lawyers, accountants, for some lenders, they can go up to 90% without paying lender's mortgage insurance.
Oh, okay.
And currently there's the government first home low deposit scheme lottery. It's not normally having lottery after its name, but they've got 10,000 places available, and there's about 100,000 first home buyers in any given year, so you've got a 1 in 10 chance of getting it. And it does let you go up to 95% on a first home purchase without paying lender's mortgage insurance.
Right.
But what do you think lender's mortgage insurance covers you for?
Just for in case of default?
Yeah. So just to be really, really clear, it covers you for nothing.
It's covering the bank, not you.
Bang on, yeah. So let's just walk through a scenario. So imagine you bought a property for $700,000, and you got a 90% loan, which is $630,000. And then, we went into a longer lockdown. The economy started to go backwards, and you couldn't pay your mortgage. Now, if you don't pay your mortgage, the first month you get a letter from the bank saying, hey, you didn't pay your mortgage. Second month you get another letter saying, hey, you didn't pay your mortgage. Third month, in Australia, banks report 90-day arrears to shareholders, and so now you're on their, what's the polite way of saying shit list?
Blacklist.
You're on the blacklist. Yes, that's right. So from then on, you're their legal team. Their legal team are now chasing you up, saying, "Listen, this is getting serious. It's been 3 months now. You've not paid your mortgage. How are we going to resolve this?" Now, what the banks are entitled to do under a mortgage is apply to the courts to take control of your property, put it on the market, and sell it to get their money back. Okay. Now, it takes them about, on average, 6 to 12 months to do that. But let's imagine this nightmare scenario. You've got no income coming in. You've tried moving back with family and renting it out, but the tenant's not paying the rent. So you just simply can't pay the mortgage. Now, in this nightmare scenario, maybe unemployment has skyrocketed. And so as a result of that, not only are you not able to pay, but lots of people are not able to pay. And the property prices are now crashing.
Right.
Now, in the first instance, the bank needs to get their money back, which is $630,000, plus whatever they've added on for the interest that you haven't paid for the time you haven't paid it. Now, they have the right to sell the property, and they'll usually pay the agent and then get their money back. But imagine in this nightmare scenario, they can only sell the property for $550,000. Okay? So they sell it for $550,000. There's an $80,000 gap between your mortgage and what they get back.
Yeah.
They will then go to the mortgage insurance company and say, hey, listen, we're out of pocket 80 grand. Can we get a payout? Lender's Mortgage Insurance will pay them the $80,000. And then guess what happens next?
You lose your home.
You lose your home, and the insurance company has now had to pay out $80,000, and they want to know whose fault it is. It's yours.
Yeah, my fault.
It's your fault. You didn't pay your mortgage. You got in over your head. So now the mortgage insurance company is chasing you for $80,000, and you've got to sell, your laptop, any car you've got, all your personal possessions. And if you can't pay the $80,000 back, you're going to have to go to the courts and declare bankruptcy.
Right.
So really crystal clear, Lender's Mortgage Insurance covers you for nothing.
Right.
Okay?
Okay.
Now, the other interesting thing about Lender's Mortgage Insurance is because the higher the percentage you borrow, the bigger the risk that the insurer is going to have to pay out. And so what that means is the insurance premium, the cost, goes up depending on the percentage of the value of the property you borrow. So 80%, there's no premium. But at 82%, there's already a 0.7% premium.
Right.
And 0.7% on $600,000 would be about $4,000 up front.
Right, okay. And that LMI that you have to pay once it's over 80%, can that be included within the loan, or does that have to be paid outright before?
Yeah, so lenders will always lend you the money to pay their insurance premium, which is lovely of them. But what it means is that if you think you're borrowing 82% and you're paying 0.7% in mortgage insurance, your loan is 82.7%.
Okay.
Now, when you get higher up, by the time you get to 88%, the mortgage insurance is about 1.5%. Depends on the value of the property, but in this example, 1.5% of 630 would be about $9,000.
Yeah.
Okay? Now, when you add $9,000 on, or 1.5%, you're now at 89.5%, just under 90. Now, 90% is a magic number. If the loan, including the mortgage insurance, is below 90, the insurance premiums are not that bad. Once you go over 90, they skyrocket. So, for example, at 90%, if you borrow 90%, the percentage might go from 1.5% to say 1.8 or 1.9%.
Yeah.
And that increases the cost quite dramatically. And so typically the extra borrowing that you get, that extra 2%, 2% on $700,000 is $14,000. So by borrowing the extra $14,000, typically the mortgage insurance premium will go up by around about $4,000. And so the question is it worth having a 14 plus 4, an $18,000 bigger mortgage to get that $14,000 from the bank? Or can you scrape that together from other savings, friends, family, whatever you can, in order to save that? Because it's about 30%.
Right.
Once you go over 90%, a lot of lenders will say, oh, you can go up to 95%. But that typically means 95%, including mortgage insurance.
Oh, okay.
And the mortgage insurance rate at 92% is about 2.5%.
Wow, okay.
So suddenly you've gone from 92 to 94.5, and you've only gone up 2%.
Right.
So
wow.
it's very rarely worth getting that extra money in terms of the lender's mortgage insurance cost. But at the same time, if it lets you buy the property that you want and it lets you get into the market and you're confident that prices are going to go up and not down, maybe it's worth paying. But we would always try and encourage you to find another way of getting that money. So we've mentioned before, friends, family. You can also sometimes take out a personal loan. The bank will add that to a liability.
Yeah.
Go on, you had a question?
Yeah, I was just going to say, is a personal loan ever really a good idea? Because whenever I'm, helping out clients, looking at applications and research, and whenever we run these credit reports and they've got a personal loan just for that LMI or just for that little bit, it always seems very scary to me because it's just liability on liability.
Well, that's true, but then so is the loan if you were going to take it from the bank. So if you had to go from 88% to 92%, that extra 4% is $28,000 in that example of the $700,000 property.
Right.
So if you're going to borrow $28,000 from the bank and then they're going to charge you, probably an extra $7,000 or $8,000 in mortgage insurance to get that money, or isn't it better to borrow 28 and owe 28 than borrow 28 and owe 35?
Yeah, you're right, yeah.
Not necessarily. So what we would normally do is we would do the figures, because if you take the personal loan and it takes you 7 years to pay it off, and the interest on the personal loan is 12%, then that cost could be more than the lender's mortgage insurance cost. So It does come down to how we package it up to say, well, can you pay it off in 2 years or 3 years or 4 years? Now, there is one much, much better option if your family own property already, and that's that you use a guarantor. It's a topic for another day, but it's where you basically use someone else's property as additional security, so the bank will actually lend you up to 100% or even 105% of the value of the property without charging you any lender's mortgage insurance at all.
Right, but what's the catch?
That's where we have to go into another, and we'll do that as another question about how do guarantor loans work, because it is quite a complicated thing, and then we're involving, parents or family members, and we need to understand their perspective and look at it from their perspective as well as our own. From your perspective, if you're buying, it just saves you lots of money.
Yeah.
And means having a semi-awkward conversation with your family, which is one of the reasons why what we always do is send them a copy of one of our videos to explain it, so they're not sort of in the dark about it. Does that make sense?
Yes, that makes perfect sense.
Have we covered LMI?
Yeah.
Any other questions about LMI or lender's mortgage insurance?
I don't think so. I feel like that's it. I mean, is there a way that... LMI calculators, that's one thing. So, I know that Genworth is one calculator that we use, but if I'm just researching a place that I like and I just want to work out how much LMI it would cost, I can, is Genworth the most reliable one? Because sometimes when you go on certain lender calculators, the figure's completely different to Genworth.
Yeah, so there's a couple of different issues going on here. So there's two big mortgage insurance companies in Australia, Genworth and QBE. Now, some lenders align themselves with Genworth, some lenders align themselves with QBE. Even the lenders that align themselves with Genworth, they sometimes have a different premium scale to another lender who also uses Genworth.
Oh, okay.
So for example, one of the bigger banks might get a slightly lower premiums than one of the smaller banks. That's Genworth versus QBE. Now, Genworth and QBE then have their own differences. Now, the biggest difference that you'll ever come across is for loans between $500,000 and $600,000.
Okay.
And the reason being is that loans under $500,000, they both have their percentage costs, and they're about the same. In fact, they're almost like exactly the same. And then suddenly at $500,000, Genworth puts you up into a new bracket. And so suddenly the percentage you pay is higher with Genworth than it is with QBE. At $600,000, QBE put their prices up to match Genworth again. But in between $500,000 and $600,000, QBE will always be a lot cheaper.
Right.
Now, there are some lenders that will use one or the other. And so if you do a Genworth calculator, even with a lender that normally uses Genworth, that lender might come around and say, oh no, there's a much better premium available, and this is it, because they'll quote you the QBE premium. So the best way of finding out the answer is to talk to a good broker.
Yeah.
And luckily you know one of those. In fact, you know at least 3 of those, if not 7 or 8, I think.
Yep.
But the broker needs to work it out. We've got calculators that will do it, and even the online calculators that we use are not always right. And so we always have to check it directly with the lender. Our calculators give us an indicative view and will tell us quickly if one is better than the other, Genworth or QBE. But yeah, there can be quite a difference between the different lenders and the premiums that you pay. And sometimes it's worth going with the lender with the lowest LMI, even if their interest rate is slightly higher.
That's a matter of doing the whole calculations and, as you said, going to a broker.
Yeah. There's always got to be benefits of talking to us, surely.
Sometimes.
All right, I think we better wrap this up because we've gone on long enough. But thanks very much, Tammy, for the questions and especially for the deep dive on lenders' mortgage insurance. As always, remember that we need to be genuine, have fun, and stay curious.